Joining us right now in the markets is Kathryn Rooney Vera. She is chief market strategist at StoneX. And wow, a lot to digest this week, Kathryn. Why don't we just talk about the earnings we've seen this morning? Because this next week is going to be a huge crush of earnings. So far, so good. It looks like most of these companies are coming in above expectations, at least for the financials.
That's right, Becky. And earnings expectations you've seen come down a little bit for 3Q, but rising for 4Q. My outlook is a little bit more negative. I find it difficult to imagine margin expansions and corporations doing better when you have this triple whammy of rising labor costs, rising energy prices, and rising interest rates. And if you look into 2024, the 12% earnings expectation that's baked into, or growth, it's baked into S&P 500, really, I think, looks optimistic, especially when we're talking about a deceleration in economic activity and probably earnings revisions to the downside as composite PMIs roll over.
So what do you think? Is this an opportunity, just given the momentum shift that we've seen recently, or not? Would you get ahead of kind of the return of the bulls, at least over the last week?
Well, I'm more about optimistic on fixed income than equities at this juncture. Usually when you're at the last hike of the Fed's tightening cycle, fixed income generally does very well. In fact, yields drop about 100 basis points over the course of the next 12 months. So I think that U.S. Treasury yields look enticing. I like agency mortgage-backed securities. The relative value there is remarkable. And then in the equity space, defensives generally do well at this stage of the monetary policy and economic cycle. So therein, I like utilities, which is generally a bond proxy, staples, healthcare, and I think insurance companies as well.
And in terms of rates, look, I think this is the big question. This has been the trillion-dollar question that people have been watching, especially after the lousy 30-year auction that we saw yesterday. What do you do? Lee Cooperman told us yesterday that he wouldn't be buying longer-term bonds below 5.5%, that he wouldn't touch them.
Yeah. Well, look, I think that if we are entering a phase of the economic cycle of recession and the Fed is targeting real rates, then there is a good chance that the Fed does cut rates next year. If they're targeting real rates of 2.5% to 3%, it's really hard to imagine the Fed keeping nominal rates as high as they are in a deteriorating economic cycle. In that environment, I do think that 10-year yields come down. My forecast for next year is 3.75% for the 10-year. So I do think there is space to move lower, especially if, in fact, we are at the end of the Fed tightening cycle with just maybe one more hike coming in December. Of course, we have geopolitical risks. So there is the threat of oil prices and their impact not only on inflation, but Becky, I would argue that it's more a deflationary thing going on because it will impact consumer demand and potentially bring us forward in terms of that economic recession, which is really my base case going into 2024.
Yeah, that's what makes a market, a lot of different opinions. Kathryn, I want to thank you for your time this morning. Great seeing you.
Thank you.